Are you ready?
Ready.
All right, let's go. Kevin here, top 100 financial advisor and best-selling author. We are here to talk about the stock market. Today we need to do a comparison deep dive between ETFs and mutual funds, but we want to focus on the tax side of things because, believe it or not, there is a little, I don't want to call it a loophole, but there's a little feature that comes with mutual funds that can give you a slightly higher tax bill that I think you want to know about. So in today's video, we are going to compare the differences between ETFs and mutual funds and really kind of lay that whole thing out. Now, as we do this, because there are thousands of ETFs and thousands of mutual funds, we're going to center this entire conversation around two, that way everybody can follow along. So I want you to do, as we're doing this, we're going to center this discussion around VTI. That's the Vanguard Total Stock Market ETF. You can type VTI into Yahoo Finance or into a Google browser, it's going to pull it up, and we're going to compare this to VTSAX. That is the Vanguard Total Stock Market Mutual Fund. Okay, they do the same things, they hold the same things, however the way that they do it is different. That is the only difference between the two. That's the main difference. I'll say it. That's the main difference between the two. Now you might be thinking, well, Kevin, you're talking about, index funds and ETFs and mutual funds. What in the world is all that? So if you don't know already, you definitely want to go ahead and like and subscribe, because we have covered this many a times on the channel. But essentially, ETFs and mutual funds, the way I like to describe it, it's an all-star team of investments. I just take all the stocks. In this case, it's the Total Stock Market Index Fund. It takes all of these and puts it inside of this one investment. I don't have to go out here and buy 50 different stocks. I can get one of these and it's going to have everything I need to know. Okay, that's the short version. Again, I've had other videos that describe that in greater detail, but in this case we're comparing the ETF version of this index fund and the mutual fund version of this index fund, and why could you be taxed more inside the mutual fund version. Well, it boils down to this. There are three ways. There are only three ways that you can get taxed on any of these investments. Number one, the most common, is capital gains. You buy it for here and you sell it for higher. That's it. Okay, that's pretty common. I think most of us kind of know how that regular taxation works. Works in almost every industry. If you own a business and you buy supplies and you sell it for higher, there's going to be a tax bill for you waiting at the end of the year if you own a business. Like, almost everything works in that exact same fashion. Then you could also be taxed on your dividends, how long you've had the dividends, all kind of stuff. I've actually written an article for Business Insider on the details of that. We're not going to go in that here, but in either case, you got an ETF, you make money via dividends, those could be taxed. Now, the last one here is I'm not going to call it a random tax, but you can get taxed based on how the fund is doing on its own, with nothing to do with whether you sold it or whether you've gotten dividends. This happens when mutual fund managers that put these funds together will buy and sell something. That is one of the disadvantages that mutual funds have when it comes to taxation. So let's go ahead and dive into that. For example, let's say that I own VTSAX, okay, Vanguard Total Stock Market Fund. And let's say that for whatever reason, they had 10% in Tesla and they sold 10% to go down to 5%, okay? That means that they sold something, in this case for a profit. At the end of the year, I could get a tax bill because somebody else sold and moved some things around inside the fund that I had nothing to do with. Now, in most cases, these tax bills are relatively small. However, it can happen, and it has happened to investors in the past. But if you own the ETF version, the chances of that happening is very, very small, and almost, in my case, as an advisor, I almost never saw this happen. Why is that the case? Well, it comes down to how these funds are created and the mechanisms behind it. Essentially, inside of a mutual fund, again, you usually have a board of directors, board of managers, and they decide what to buy and what to sell in actively managed funds. What is an actively managed fund? Actively managed funds are the ones that people literally sit down and say, look, based on what's going on this month, we're going to buy this stock, sell this stock, and make sure that we are following our goals. An example of this could be some of the ARK funds by Kathy Wood. She's an active investor. She sits down and says what we buying and what we selling. Well, if I'm holding it and I'm just holding on to that fund by itself, and she buys and sells something for a profit, I could get that tax bill at the end of the day. And again, I didn't do anything, but I can still get that bill if I had the mutual fund version of it. Well, this does not happen as often in ETFs based on really the way the ETFs are created. They make, I think they call them creation units, and you really don't get that same type of, I wouldn't call it a mistake, or you don't really get that same mechanism inside of ETF. It's really just how they are built. So when an ETF buys and sells certain things, in most cases, you're not going to get a tax bill. That's really it. That is the difference between the two. So what I'm going to do right now is show you a screen share doing a further deep dive between how these two things work together. Because you're probably asking, well, should I get the ETF version? Should I get the mutual fund version? Are they really the same? And is one going to make me more money than the other? So I'm going to show you that it's almost identical. I'm also going to show you a way to look at the fees to see which one is more expensive and which one is not. That is something you want to pay attention to. The last thing you want to know is this. Mutual funds, even though they could be slightly more expensive than ETFs, and you may get a small tax bill depending on the type of fund. If you got an index fund, indexes don't change that often. Okay, if you're in the S&P 500, you're probably gonna be there. You might get, stock number 499 might get swapped out every now and then, right? A Tesla gets added every now and then, but it's rare. But aside from all that, though, we're going to look at those fees. We're going to look at how they compare. But the other advantage of having a mutual fund version or just having mutual funds in general is that you can automate them. That is just a way that these things are built. Meaning that if I just want to say, I open my Fidelity account, I want to put $100 inside of an index mutual fund every 5th and 25th of the month, I can do that. I cannot do that with an ETF, at least to date. That's because the way that they are designed, you kind of have to buy shares of it just like you would a stock in most cases. If you notice, outside of Cash App, I think, and I could be wrong because these do update all the time, it's rare where you can say, I want to invest $25 into the stock and it just keeps going over and over and over again. You can deposit the money in the account, but it's very difficult in most cases outside of Cash App where you can buy fractional shares at a time. You can do it with a mutual fund. In most places you can't do it with an ETF. So that is one of the other advantages. If you want to 100% automate everything, mutual funds are still one of the best places to go. All right, let's go ahead and get into the screen share. The last thing I'm going to say, I know I keep adding on. I'm sorry that I keep adding on, but these things come to me as we're doing it. The other thing that you want to pay attention to between mutual funds and ETFs is the fact that yes, you're going to have the different prices. So the price of an ETF could be $100, mutual fund could be $1,000. It doesn't matter because you still get the fractional shares and the returns are likely going to be the same. And remember that it does matter what account you're talking about when you're holding these investments. That's extremely important because if I just have a regular taxable account, not a Roth IRA, not a 401k, not a traditional IRA, none of that, then that's where those taxes are really going to come into play. If I'm talking about traditional IRA and I'm under the age of 59 and a half, it doesn't really matter if I buy and sell for a profit. I'm not paying taxes on those now anyway. If I have inside a Roth IRA, I've already paid my taxes. It doesn't matter if I buy or sell or if the fund buys and sells for a profit. Those taxes have already been paid. I'm already fine there. So if you're inside of a tax advantage account, your 401k, Roth IRA, traditional IRA, those are just the main ones, not all of them, you're fine. If you're talking about just a regular investment account with no tax advantages, then it becomes a bigger concern. And again, these are rare inside of index funds and usually tax bills is pretty low. You're not gonna get a $10,000 bill because you invested $5,000. Okay, all right, let's go ahead and get to the screen share and I'll kind of break it down some more. All right, let's go. All right, so we're going to take a very quick look between VTI and VTSAX. So notice here, I'm on Yahoo Finances, y'all can see, and here it is right now, $201.05, and ticker symbol right here is VTI. So what I want you to do, just to give you an example of kind of how it looks, you'll see that it was up about 0.05% today, and then go to holdings. And I can scroll down here and I can see, it's all in stocks. It's a total stock market fund. And the reason why it's not 100% is probably, there's a little bit of this is probably in cash. It just hasn't been invested to this point. In either case, it's all stocks. So you can see how it is divided. And you can go down here to see their top holdings. Apple, Microsoft, Facebook, which I'm surprised I haven't renamed Meta. These are two classes of Google, Tesla, Berkshire, JP Morgan Chase, and Nvidia. Now, one thing you want to notice here is, remember when I said that the top, 3 or 4 companies, whatever I'd said in previous videos, make up the majority of the stock market? You can see that here, right? Apple is basically, let's just call this 5, 10, 13. And then you got, a little bit of Facebook, Alphabet, Tesla. Like, this is the majority of the stock market. Just these 10 holdings represent 22% of the stock market, since this fund represents the stock market. So when they announce earnings, this is where the stock market goes based on how these companies do. Now, it's a sidebar. But let's go ahead and compare this to the mutual fund version, since this is the ETF version. Okay, VTSAX, Vanguard Total Stock Market Index Fund, same thing as what we saw earlier. And we can go to holdings. Now, the reason why you see this here, the prices are different, so the percentages are going to be slightly different. You're going to see that the performance is going to be nearly the exact same. Let's go to holdings. And let's go low for us. Okay, so this one has 0.83% in cash. Very similar breakdown here. Let's go down, look at that, almost identical, right? Almost in the exact same order, I'm sure. About 4, almost 5%, and straight down the line, the exact same. If you want to get the full holdings, you can go to vanguard.com. You can also go to ETF.com and download every single holding that's in here. And I think it does tell us how many stocks it does hold, or at least it used to. I could be wrong. You could also do the math. If these 10 equal 22%, then you should be able to back out and perhaps find the rest of the holdings. But y'all see what it is made of. All right, now I want to go to the chart here on Yahoo Finance. Now notice this is VTSAX. This is the Vanguard Total Stock Market Mutual Fund version. And what we're going to do here is compare, right? And go right here to comparison. And I want to compare VTI, right? Here's the ETF version, and boom. And I'm going to change the color because it could get confusing. We're going to change it to red. Notice there's blue here in the background. Let's change it to red. And boom. These two things, the performance is identical here, right? You're not going to make any more or less per se based on investing in one or the other. It really does not matter from a return perspective. Now, if I change the year, it might be off by just a bit, but these returns are nearly identical. It's not going to make that big of a deal. So there they are. You can see it's a smidge higher over the last 2 years. One of them is. I'm assuming it's the the ETF version. I don't know, but again, you can see they trace each other because they're the exact same thing, just different ways of getting to those answers for these two funds. So that is how they are comprised, just to show you that they are the same, to show you that the performance is nearly identical. So let's move into what the fees look like between the two. All right, what you're looking at now is the FINRA Fund Analyzer. So it analyzes what if you had two funds over a period of time and you had the exact same return, what would the fees be? You can see that we are comparing VTI to VTSAX, and these are different products. And they say products because one's an ETF, one's a mutual fund. It's not necessarily apples to apples, but did want to show you the differences. Now we're saying if you invested $10,000, this would be the fees. One is $38, one is $51. Okay, for $10,000, I think both are fine, but the ETF is slightly cheaper. And it's going to show you the annual operating cost. So again, $38.61 a year, $51.55 per year. That's it. That's all you would pay. That's why these are so popular, because they are very, very inexpensive. You can see the difference here is 0.03% for the ETF, 0.04% for the mutual fund. Index funds, again, extremely cheap. That's why you hear so many people talk about it. And that's really it. Those are the differences. The way that an ETF works on the back end, that you're not going to see that much complication. It's also why if you were looking at this price, let's see if it's going to let me go to it. If I'm looking at the price of an ETF during the day, it's going to move throughout the day, just the way that it is built on the back end, whereas a mutual fund is not. So Those are the real big differences. That is how you are taxed. You could be taxed depending on the type of mutual fund you have and the type of account you have, just based on the fund managers and what they're doing on the buy and sell end. So that is it for the video. If you like this and you like this kind of deep dive breakdown type of stuff, then you are going to love the members only. So I'm telling you now, you want to go ahead and join. We do exclusive videos each and every week. Like, subscribe, do all that stuff. If you have any other questions, feel free to let me know in the comments, or you can hit me on Instagram, because that's how I got the answer to this question. All right, or the question to this answer. You know what I'm trying to say. That's why I got the question for this video. All right, y'all. I will talk to y'all tomorrow. Bye.